Hey, this is Shannon. Let's talk about the Fed, and more importantly, clear up some confusion about how the Fed does and does not affect mortgage interest rates. The Federal Reserve, often referred to as the Fed, is the central banking system of the United States. It has the authority to influence interest rates and the overall economy through various tools at its disposal. One of the primary tools the Federal Reserve uses to affect interest rates is the manipulation of the federal funds rate. The federal funds rate is the interest rate at which banks lend money to each other overnight to meet their reserve requirements. By adjusting this rate, the Fed can indirectly influence other interest rates, including mortgage rates. When the Federal Reserve wants to stimulate economic growth, it typically lowers the federal funds rate. A lower federal funds rate encourages borrowing and spending. In response to a lower federal funds rate, banks may lower their prime lending rates, which are used as benchmarks for various types of loans, including mortgages. Here's a fact. The Federal Reserve does not directly set mortgage interest rates. Most mortgage programs and rates, such as the 30-year fixed, are not directly tied to the Fed's decisions on the federal funds rate. And there's not a one-to-one correlation between fixed-rate mortgages and the Fed funds rate. Mortgage rates are influenced by a variety of factors, including market conditions, investor demand for mortgage-backed securities, inflation expectations, and the overall health of the economy. However, the Fed's monetary policy decisions and actions can and do influence mortgage rates indirectly through its control of the federal funds rate and overall economic stimulus efforts. When the Fed has scheduled a meeting to announce a decision about the Fed funds rate, typically the market has already anticipated what the Fed will do. So it's already built into the market the day the Fed makes its announcement. Fixed-rate mortgages on the day of the meeting will often be more influenced by what is said in the announcement than what the Fed actually does to the rate, whether it's an increase, decrease, or nothing at all. One exception to this reality is the home equity line of credit, otherwise known as a HELOC. If you have a HELOC, those loans are usually tied to the prime rate and will move lockstep with the Fed funds rate. Meaning, if the Fed cuts rates by 0.25%, the interest rate on a HELOC will decrease by 0.25%, and of course, vice versa being true as well. Other actions of the Federal Reserve can also impact long-term interest rates, like quantitative easing, QE, which is when the Fed buys or sells large quantities of Treasury or mortgage-backed securities, which can help either lower or raise long-term rates. To sum it all up, you might say the Fed is a significant influencer of mortgage interest rates, but it's not the final authority. On any given day, it's entirely possible to see a lower Fed funds rate that doesn't lower mortgage interest rates. Rates can be unpredictable and volatile depending on the season, and there are equally important factors that go into your mortgage lending rate, such as your creditworthiness, loan term, loan-to-value ratio, etc. These factors can vary from borrower to borrower and can have an impact on the interest rate offered by lenders. It's especially important to understand that the factors are in your control. If you have any questions about how to get the best rate right now, reach out and let's crunch some numbers to see if a mortgage makes sense for you.